do not tax loss harvest just to do it. You want to make sure it makes sense and there is a lot of value in that tax loss for you. Hey everybody, welcome back to my channel. In today's video, I'm going to talk about tax loss harvesting. It's a tongue twister a little bit. Strategies for 2022. Tax loss harvesting is basically taking losses you have in different assets, whether that's losses in stocks, losses in crypto. You essentially sell those assets at a loss to use that loss to net it against any current or future gains to help us pay less taxes on the gains. So a lot of people towards the end of the year, going into the end of the year, they're going to be thinking about this, or at least they should be thinking about this. Sometimes what happens is people don't think about tax loss harvesting strategies until it's too late. You have to tax loss harvest before the end of the tax year. So in this case, we have up until the end of 2022 to sell some positions that are underwater and try to utilize those losses for either current gains or future gains. And I'm going to explain in this video when you should do that and when maybe you shouldn't do that. So just to put a fine point on this, say that you bought some Rivian stock and your Rivian stock is underwater a bit. Right now we are down 81% basically in 2022, which is a rough go. So let's say that you want to sell this Rivian stock for a loss because you do not think it's going to recover. This is just hypothetical. Maybe you really do, but you'd rather take the capital that you have left and use it elsewhere, something like that. You sell the stock, so you sell Rivian before the end of the tax year, and you now have a capital loss that you can either write off on your taxes up to $3,000, or you can take that loss and net it against other gains that you have to lower your tax liability. Okay, so that's just using it in theory here. As far as the $3,000 loss that the IRS allows you to deduct every single year above the line, remember above the line deductions are awesome. Basically what that's saying is the IRS says, hey, if you end up with $100,000 of losses, we're not going to let you deduct all $100,000 of those losses. We're going to cap your losses to $3,000, and that's all you get to deduct on your taxes from your $100,000 loss. We will allow you to carry whatever excess losses you can't deduct over to the following year. So in this example, if you have $100,000 of losses straight up, and you can only deduct 3,000 of them in one given tax year, you're going to end up with $97,000 of a carryover loss that you roll over into the next year. And then again, the process starts all over again. One of the reasons that people may want to take advantage of tax loss harvesting is because they're kind of thinking about those future years. They're thinking about that carryover that they're going to have, and they're going to be able to net it against future gains if we have great years ahead of us, right? If we go into a bull market, or if we decide to take more gains out of long-term compounders that we've got in the portfolio, we can have that loss in the back of our head, that carryover loss, knowing, okay, it's there, I can use it, therefore it's going to help me control my tax situation a little bit better. And that goes into making selling decisions when you're looking at your stocks and your crypto and etc., right? You're thinking about you should be thinking about all of that as a collective. And you might be thinking, what gains, Nikki? 2022 has been a doozy for the market and everything is down significantly and we're in a bear market. Well, let's talk about that for a second. So as you can see, yes, we are in a bear market, and the reason that I'm specifically talking about tax loss harvesting in 2022 is because we are in a bear market and a lot of things are giving us a lot of losses, right? So now is the time where we want to be thinking about this strategy. This is a chart in YCharts of the major indices I've got the NASDAQ on here. I've got the Russell 2000. I've got the S&P 500. And you can see that all three of these indices are in bear market territory, which is 20% or more from the highs. So it has not been a pretty year for stocks. And it's also not been a pretty year for crypto. So that's why I'm being very specific about 2022, because these are the types of market environments where you want to be thinking about cutting the losses that are probably not going to recover anytime soon or at all, and maybe redeploying that capital elsewhere. Or B, and this goes to what I was saying earlier, how you might be thinking, what gains would I possibly have in 2022 to net losses against, right? Well, let me give you an example from my actual investing. I personally had a lot of long term capital gains in Apple, for example, and I wanted to trim some profits off of that position because I wanted to take that money and I wanted to invest it in other opportunities as the market was going down. So in my scenario in 2022, even though the market is down and I have a lot of positions that are underwater right now, I will likely have a long-term capital gain in 2022 because I took profits from long-term positions that were up a lot. In 2022, since I basically sold some gains, took some cash out of certain positions that were doing well, I am thinking, okay, what can I sell to what do I think is not going to recover in my portfolio? Or what do I want to maybe switch out and upgrade into something a little bit better with that capital? For example, if I have a position in a small cap that's really not doing very well, I may sell that and take that capital that I have left and put it in something higher quality while the market is showing lots of opportunity in a lot of these high quality names. Part of the strategy is, hey, I have these gains because I, took profit in 2022 to use that capital to buy stuff. Well, maybe I've got some positions or some quote unquote stinkers in the portfolio that I can just take a tax loss. I can sell them and take that loss to net against my gains in my Apple stock. So here's a hot tip, okay? You want to make sure that you're tracking your losses. You want to make sure your CPA is tracking your losses. You want to make sure that your tax returns are tracking your carryover losses. So basically, if this is done correctly by you and or your CPA, you will know what your capital loss carryover is. It'll be documented in your tax return. This is actually the capital gains and losses schedule D that attaches to your 1040 form for that's your personal tax return. And basically there's a worksheet, a capital loss carryover worksheet that gets done every single tax year, so you'll know what your running tally is of your capital loss and what you're using up going forward. So make sure it's all being tracked and accounted for, because you don't want to forget and you don't want someone to mess something up and it not be accounted for, and then in future years when you have gains, you had capital losses that you could have used to net against those gains, but unfortunately something went wrong or somebody didn't do something the right way. So that's just a little hot tip. Let's talk about strategizing tax loss harvesting, because what a lot of people immediately do is they say, ooh, I can sell my losses and I can buy it back, right? And I can take the tax loss and then I'll buy it back and then I'll just keep owning the stock. And it's like, I just continue to own the stock, but I have this loss that I can take advantage of. Well, the IRS has your number and they have implemented something called wash sale rules. It's what keeps you from doing what I just described, right? You can't really get too cute. So a wash sale is basically if you sell a stock for a loss to take advantage of that loss on your tax return. If you buy back that stock, basically within 30 days, there cannot be transactions on that stock 30 days before or 30 days after the date that you sell. So there's this technically 61-day period, and you have to wait 30 full days until you can buy that stock again after you sell. So what that does is it opens you up to risk. And here's why. If you sell a stock at a loss in your portfolio and you have to wait that 30-day period, say you want to still own the stock, you just wanted to take the loss, you have to wait 30 days. So what that's going to do is it's going to make you a sitting duck, because what happens if within that 30-day period a buyout announcement comes out? What if in that 30-day period that you're having to wait, an awesome, unexpected, great performing earnings report comes out, right? And the stock jumps. Well, what that does is now, when that 30 days is up, the stock could be way higher and you're having to buy higher than you expected because you had to wait, right? To avoid the wash sale rule. So it's a risk trying to get cute with selling for tax losses when you still want to own the stock. You have to really be okay with the fact that the stock could end up making a move within that 30 days that's out of your control and you aren't able to buy without triggering the wash sale rule until that 30 days is up. So I say with strategizing this, make sure that the tax loss is actually going to be worth it. The tax loss is essentially worth whatever your tax rate is. If it's a long-term capital gain, that's your whatever your long-term capital gains rate is. If it's a short-term capital gain, that's going to be whatever your ordinary income tax rate is effectively. So that's what the tax loss is worth. So you have to really decide, because if you are in a lower bracket, if you are not really paying a lot in taxes, then it might not be worth doing it if you still want to stay in the stock and don't want to risk that 30 days being a sitting duck where anything could happen with the stock, and you could end up missing out, right? So it might make more sense instead in that case to average down on the stock instead of selling the stock for the loss. Instead of selling it and taking a loss, average down and buy more shares at a lower price to lower your cost basis if you really are confident and you really want to keep that stock in your portfolio. Do not do tax loss harvesting just to do tax loss harvesting. You have to really make sure that you're actually going to benefit from it enough for it to make sense, right? I know last year in my scenario, I had a lot of gains because 2021 was kind of a crazy year and we had a lot of gains in 2021 as the stocks were roaring. So I, at the end of the year, absolutely cut some positions. I do not want to be in this position right now. I will revisit it later when the fundamentals change or when just the broad market environment changes. And that ended up actually being a really good decision for me, and I was able to buy back way after the 30 days. I did not trigger wash sale rules, and I ended up recently selling one of my companies that got bought out for a gain. So that ended up working because I took the tax loss in 2021 and I ended up buying the stock back much later. The stock was dead for a long time, so I wasn't worried about missing out on too much in that scenario. And even if I did, this is life, right? I took that risk. And then in 2022, stock got bought out. I was in it. I was able to sell it. So that was the kind of perfect scenario, but it doesn't always work out that perfectly. And you just have to know the risks of doing that. And you have to know the market environment that you're in, if you're going to be doing that type of maneuvering. All right. So to recap, basically, it's tax loss harvesting season. Take a look at your portfolio, figure out what you think is just not going to recover, that maybe you could sell, get it out of the portfolio, and take that capital and reinvest it somewhere else. Take the tax loss, use it to your advantage, whether that's this year or next year. Remember, the loss will be carried over. You'll be able to take that $3,000 off the top of your gross income for AGI purposes anyway. So, helps a little bit, right? And if you have gains, say you did take gains in 2022 from selling positions that you've had for a long time that had a lot of a gain locked into it, well, you can utilize 2022, which has been a pretty nasty year, to take some of those losses and just sell them and tax loss harvest them to net them against gains that you maybe took, so you could deploy some capital and get some more cash in that portfolio this year during the bear market, which is the right thing to do. I've done a lot of that in 2022, sold a lot of long-term positions that I had, took that cash. I've got cash now. If the market continues to sell off, I'm ready to go. Okay. The other thing is, do not tax loss harvest just to do it. You want to do it thoughtfully. You want to make sure it makes sense and there is a lot of value in that tax loss for you. Okay. If you're in higher tax brackets, that's when the value of the tax loss goes much higher. But if you are unsure, then do not overthink it and do not think that you have to tax loss harvest just because it's a cool buzzword. If you're in losing positions but you believe in them long term, it could very much not make sense for you to tax loss harvest, and it could make more sense for you to just average down. All right, y'all, I hope you found this helpful. Please like and subscribe. Tell me in the comments below what you're thinking on tax loss harvesting season this year. Are you going to be selling some losers and maybe getting into some other positions? Or are you going to be just hanging on to stuff because it really doesn't make a lot of sense? I'd be curious to hear your thought process in the comments below. Happy to help if I can. And I'll see you next time.